people think that their income outlook is worse today than it was when unemployment was 10% at the depths of the global financial crisis, the Great Recession. So they're more dire now. Imagine what the situation will be for them as the unemployment rate moves from 4.3 to 5 to 6
Right.
to 7.
People need to understand that the world has changed materially, in a meaningful way that perhaps isn't obvious right now because markets are still pretty high and there's a lot of time and energy and focus placed upon what the stock market did today. And the market bounced back after that wobble last week. This is a much bigger, more secular change. And those are sometimes difficult to see when you're this close to them. If you step back, which is the beauty of looking at things through a historical lens, you can see them quite clearly. But at the time, and if you're not paying attention, they can be very difficult for people to see.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Now, here's a fun question. What's better than interviewing your favorite macro expert? Well, interviewing both your favorite macro experts at the same time. I'm happy and honored that today we get to sit down with Stephanie Pomboy and her frequent partner in crime, Grant Williams, to hear their latest outlook for the economy and the markets, plus, if we're lucky, a bit about sports and maybe the meaning of life, too. And I can't promise whether Stephanie's dog Wilhelmina will make a guest appearance or not, but hey, we can always hope. Grant and Stephanie, thanks so much for joining us today.
Thank you for having us, Adam. That's quite the intro. And
Indeed.
Wilhelmina
Indeed. Hey,
is
Adam.
snoring away in the background, so trust that's
Yes,
not
that's
me
her, not me,
snoring.
just so we're clear. Yeah, exactly. I want to point that out at the outset.
All right, guys. Well, look, I feel like it's Christmas and my birthday all wrapped up in one today with both of you here. Thanks so much for coming on. Really interesting time of the year to come on. There's a lot that's already happened and a lot of uncertainty lying ahead. Can't wait to get your guys' thoughts on. Very quickly, though, you guys were telling me about a special event that you guys are producing later this year, and it's something I think this audience would be really interested in learning about. I'll give you plenty of time near the end to kind of give all the details, but real quickly, can one of you just give kind of a high-level description of what you guys are doing together later this year?
Sure.
Grant, you want to
Steph, you
take
wanna
it?
go? I'll take it. I'll happily take it. We are under the auspices of our great friend Dave Iban, who has been a guest, a two-time guest, I think, on the Super Terrific Happy Hour, our joint podcast. We are having a one-day shindig down in Tampa, Florida, on November the 14th. We've got a bunch of great speakers. Dave is going to be joining us, of course. We've got Kathy Wood joining us for a debate with Dave about what constitutes value, which
Wow.
has raised a lot of eyebrows, but which I think is going to be absolutely spectacular. Peter Atwater's joining us. Who else we got, Steph?
Cy Jacobs to
Cy
talk
Jacobs is
about
joining
the
us.
financial sector. Nothing really going on there, so that should be interesting. And then we've got Bob Rodriguez, who's a long
Your
time.
favorite.
Yeah, he's my longtime client, friend, and mentor to talk about how he sees the investment backdrop right now and his new passion, which is rare coins, which, he'll talk about hard assets in general, but the appeal of rare coins in particular. So that should be interesting. And see, we're going to cover a lot of very different terrain in this one-day shindig. And it will be capped off appropriately with a super terrific happy hour with libations aplenty. So
yes, and we are going to try and record a live podcast through that, which should be interesting, Steph.
Grant keeps saying that, and all I care about is that I have a margarita on hand for that part.
You will. Don't you worry about that. Don't you worry
anyway,
about that.
That's sort of the thumbnail of what we're going to be doing in November. And it's a week. Is it a week after the election? So it should be rather interesting timing.
Wow. All right. So lots of processing to do based upon those election results.
They should have finished recounting the ballots in Florida by then, I would think. Steph.
We're hoping.
Well, gosh, that event sounds fantastic, and I can already kind of hear the excitement and interest from the viewers here. Where, if folks are interested in learning more about this and maybe even attending, where should they go?
Well, I think we both posted links to it on our Twitter feeds, haven't we? I'll post it again.
And
Um,
I'll pin it to my bio, so it'll be pinned in my Twitter bio, and I will show Steph how to do that.
yeah,
All right.
I think I know.
Okay,
Maybe.
You know what, guys? You know what I'll do too is send me the link, and
Right.
I'll
okay,
put a
great.
redirect at thoughtfulmoney.com/super
Terrific.
happy, and that'll redirect to whatever link you guys give me. So, and I'll put
Fabulous.
that, folks, I'll put that link in the description below this video too. So we just want to make sure any way folks want to get there, they can find out more about this event. Sounds great. Having spent time with both you guys in person, I can personally attest to how fun and incredibly valuable that is. But with the cast of experts that you guys have put together here, a full day where people can, listen, presume, ask questions of these folks, after they
yeah.
speak, and then even better, kind of mingle with them, in between presentations, during your cocktail party, whatnot. I mean, it's a tremendous value, tremendous opportunity that most people watching this video just would die to get. So I'm super excited. I'm going to ask you guys how I can kind of squeak into the back door of this event later on when the cameras are off.
We'll make that happen.
All right. Well, look, like I said, lots to talk about. If we can start though with the general question that I like to ask everybody when they come on. I'm going to ask it in a second, but Steph, maybe we'll start with you, and then Grant, you can chime in. And as I mentioned to you guys before we turned on the camera, if you agree largely with the person who answers before you, don't feel any pressure to have to just regurgitate what they said. Just say either like, "Yep, I'm in full agreement," or highlight any points where you might differ or have something additional to add. I just don't want you to feel any pressure to fill airtime for the sake of filling airtime. All right, Grant, Stephanie, what's your current assessment of the global economy and financial markets? Steph, let's start with you.
Okay. Well, I mean, I know Grant is going to have to back up everything I say, otherwise we'll take it out back. But just kidding. Actually, I think we have some different views on certain facets of the outlook, but broadly, my sense is that we're probably in recession right now, and that we've probably been in recession for a while, and that relates primarily to my readings of the consumer economic data. We've seen any variety of indicators that suggest the consumer is in recession, like inflation adjusted retail sales, which have actually been flat for 3 years solid, which is, unprecedented outside a recession. And then, of course, what got the markets here on fire a week ago, the payroll employment report. There have been components of the employment reports over the last several months and quarters that have been sending recessionary readings, including the average hours worked. And most importantly, I would say the collapse in full-time jobs. Whenever you see full-time jobs declining, you're in recession. So there are a variety of indicators that suggest that we're there. And the question is when the markets and the Fed are going to wake up and realize that. And my forecast for as long as I can, go back to has been that the Fed would, as always, act in response to the realization that the recession was here, not in anticipation of it, as the markets seem to be wagering rather heavily. I was always highly skeptical of this immaculate pivot thesis whereby the Fed would cut rates before anything really fell apart in the economy or the market. That hasn't been their history. And so I'm just betting on the status quo, and so far that seems to be playing out. So I have a fairly negative outlook for financial assets because I think the Fed will arrive late, and we'll get into a risk-off phase, not unlike what we saw last Friday. And then they'll come in as usual, rushing with the fire hoses and over accommodate and lather, rinse, repeat. All
Okay.
yours, Grant.
All right. Yeah, Grant. So what would you add onto, around, or under that?
Anytime you get to go after Steph, you've got problems because she's just too damn smart for her own good. But what's been interesting to me is that for the longest time, whichever way you saw the world, if you were bullish, you were bearish, you thought we were in a recession, we thought that we're going to have a soft landing, there have been data points you could find that will confirm that view. And there's been a lot of people out there, pounding on tables saying, don't look over here, look at this, because this confirms my view. The Fed's going to nail the soft landing. Everything's going to be fine. things are going to be good. Meanwhile, in the background, beavering away has been Steph. And for anyone that doesn't read her stuff every week, you really should, because what it contains are all the data points. And after a while, it becomes impossible to argue with the data points. And Steph has been, as you said, following the consumer for a long time, following unemployment for some time, following credit spreads. These are really important signals for the state of the market and the likely path of risk assets. And they've been screaming, 3-alarm fire, 4-alarm fire for quite some time now. And it's starting to become much, much tougher, I think, to find the kind of the gap in the clouds that you want to point people up to and say, hey, look, the skies are blue. And of course, the Fed will at some point cut. It's weird when you watch how the process plays out that people expect the Fed to cut, and so they buy risk assets. When we get to this point in the cycle where the reason they're going to cut is that we're in recession, and a lot of the things that you're buying in advance of that cut, you don't want to own once they cut. And it's the same every time. The first rate cut always coincides with a downturn in the markets, and I think that's where we are. I think Steph is right about that. The one thing I would add to what Steph said is we have a far more nuanced world now. We've had this period of time where all the boats have gone up or down together, and policy has been coordinated and policy has been aligned. Everybody's self-interest has largely been roughly the same. They might have been slightly ahead here or slightly behind here there, but generally there's been this alignment in terms of desired policy outcomes. Now the world's very, very different, and we have a bunch of countries. If you look at the US, you look at Europe, you look at the UK, look at Japan, which I think is incredibly important once again, look at China, and each of them is now suddenly having to manage domestically first and not be good citizens of the global central banking world. And we got a real taste of this recently in Japan. Last week when we saw, on July 31st, we got the minutes from the Bank of Japan. We got the rate hike, from the Bank of Japan. 25 basis points, which in the scheme of things is nothing. But it's the intent that they've signaled. That was really, really important. The market started to fall on the back of that, but it didn't really fall hard until the minutes came out, and it's almost as if the market collectively said, wait, what? They're serious about this. And I find this extraordinary, because you can say whatever you like about the Bank of Japan, and many of us have been for many, many years, but they've stuck to their guns. And you can call their policies crazy, you can call them reckless, but they've continued to follow them as they said they would for 20 plus years now. But suddenly people believe that once they turn around and say, hey, we're going to normalize, is the phrase they've used. They haven't put a number on it, but in private conversations, they're talking about 1 to 2%. Suddenly people believe they're not serious and they're not going to go through with it, no matter how dumb it is. Now, we saw what happened when this became apparent to markets. The Nikkei fell 12%. It, in fact, fell 25% from its peak in 16 trading days, which is kind of wild. But it bounced aggressively when the deputy governor of the central bank said that the Bank of Japan wouldn't raise rates when markets were unstable. That seems to have been enough for people to believe the hype that central banks are held captive to markets and that they won't do anything to upset the apple cart. But I suspect, as I said at the beginning of this rather long-winded diatribe, that we're now in a world of every man for himself with regards to monetary policy. And so the coordination you're going to get, I think, is going to be a little harder to reach. You're going to have central banks cutting while others are hiking. You're going to see interest rate differentials narrow and widen, and you're going to see market participants take advantage of that. And with the fragile nature of everything and the ease with which a lot of this capital can flow, I think you're going to see a lot more volatility. And I think that's something that certain market participants love, but the vast majority of them dislike with great intensity.
Yeah.
Just to connect
Adam,
a couple.
Yeah,
Go
I could
ahead.
add just
Go
one
ahead,
quick
Steph.
thing. Since we're talking about the Bank of Japan, one thing that really surprised me, to your point, Grant, about how people kind of put their fingers in their ear when the Bank of Japan said, we're planning to take rates up, and we mean it. We're going to normalize policy. It's really underscored if you look at spec positions in the yen. So the Bank of Japan actually started raising in March. Did a modest rate hike from March till last Friday when, the markets panicked again. spec positions in the yen got even more aggressive in terms of shorting the yen. And if you think about it, here's a uh, whole market that basically is betting that the Fed's going to ease,
Mhm.
which would seem to put downward pressure on the dollar versus the yen, and then confident that the BOJ was going to do nothing. So they were completely offsides, on this wager, betting, that the Bank of Japan was basically going to be a patsy to the market. So I think they sort of fashioned themselves quasi Soros versus the Bank of England, when the BOJ said we're going to
Right.
start normalizing, they were kind of, like, okay, we dare you. Go ahead. We're going to get even more aggressively short the yen and build up even more leverage. And so I think what we saw last Friday was kind of indicative of this point that Grant is making, that, oh my God, you really mean it? And so we'll see if that actually sinks in or not, because as he also mentioned, they kind of backpedaled a little bit about how they weren't going to do anymore as long as the markets were volatile, or whatever phrase they used. So we'll see. But I think that was a real shot across the bow. And given how long this trade has been going on, I mean, as long as I've been in the business, the yen carry trade has been a thing. One can only imagine that unwinding that will not prove to be a 2-day affair, as people seem to have
Mm.
concluded it was
Yeah.
last week.
I just, Adam, if I know, I don't want to labor this point, but I think it really is important. And I know a lot of people don't necessarily care about Japan, but the importance of the yen carry trade ripples far, far outside Japan. And what we saw when the Fed raised, nobody thought the Fed could get anywhere near 5%, especially as quickly as they did, and nothing broke. And so to doubt that the Bank of Japan are serious to get to 1% is kind of crazy, really. I mean, look, maybe they don't, but it's not about that. It's about the intent, and it's about the fact that they'll go ahead and do this until they break something. And I think people potentially believe that they broke something last week and now they realize that and they're not going to do it again. I don't necessarily think that's a particularly sensible bet to make.
That's a given. Yeah. It's a lot of really important points wrapped up here. And one on the importance of the carry trade. I mean, I've seen lots of analysis, going around recently, sort of showing the very tight correlation between the carry trade and the run up in the major stock market indices, the run up in Bitcoin. I mean, there are all these trades that have been basically enabled or given a great tailwind by the yen carry trade, that if that carry trade does unwind or does go away, does stop, it just raises some very big questions about a lot of other trades that people really care about and know about, even if they don't really follow the yen carry trade that much. And to your point, Grant, and your Stephanie, you know, what's happened here with the yen is in the Bank of Japan is not that dissimilar between the markets here in the US and the Fed, right? I mean, all through 2023 and into 2024, the markets were always predicting a Fed pivot, right? I mean, they were predicting pivots all through 2023. Coming into this year, they were predicting at the start of the year like 6 rate cuts this year, right? And the Fed has every time the markets have had to blink, and it seems like that game is now potentially starting in Japan as well. What you were talking about, Grant, echoes very much what our friend Michael Every talked about for many, many years. He's been talking about how the kind of globalized one world order is now fragmenting into this much more mercantilistic protectionist regime. And more of the evidence that we see here seems to be that's the case, where at the end of the day, the countries are saying, hey, look, yeah, I know we kind of had this global kumbaya playbook, but I got to take care of me and my people now. And that's the way it's going to go from here. So just ending, another point I took from you guys is I know you guys have talked to Ben Hunt, and he talks about when something becomes common knowledge, and you're talking about several trends, whether it's that, hey, the economy is slowing down enough that we are going to have some negative repercussions from that, or whether it is hey, the world order has changed and these historic correlations aren't going to exist anymore. I think we're getting closer and closer to the point where some of those things become common knowledge. And then everybody sort of has to say, well, wait a minute, if that's really the way things are going, I got to change what I'm doing here. And I've talked about this a fair amount recently, but I think an important development along there, like you guys are having Peter Atwater at your conference, right? Behavioral economist. With Peter, it's all about sentiment, right? It's all about confidence and sentiment. And the US just went through a very big confidence shaking moment where we basically had a president that everybody was telling us was totally fine, was definitely in it for the long haul. And then in a very short period of time, basically after the botched presidential debate, sentiment changed overnight, and all of a sudden, a whole bunch of things that people didn't think were possible happened very quickly. And when you have something like that happen, it's very natural to then ask, wait a minute, what else am I taking for granted that might not be, rock solid anymore? And it opens the door to these types of shifts. So sorry, a little bit of a long-winded answer to your guys' wonderful answers, but I think you picked up on a lot of really important points there. I'll move on in just a second, but any quick reactions to that?
I would say I love this comparison with that debate and how it was a pivotal moment and a shift in confidence about the outlook. I think that it's a really interesting parallel to this realization last Friday with payrolls in the markets that, hey, wait a second, maybe the Fed isn't going to act preemptively. To me, it was Wall Street's equivalent of the Democrats discovering that Biden was incapacitated. I mean, the signs were there for a long time and everyone ignored them. Same with the economy and the idea that we were heading into recession, if not in recession already, much less the long and lugubrious history of the Federal Reserve getting it wrong every single time. So it struck me as kind of a parallel awakening, as it were, from that political one to the financial one.
All right. God, I could peel the onion on each of these questions all day long, but I'm going to move on a little bit to something I know you guys talk an awful lot about, inflation, deflation, basically your inflation outlook. I know that this is the question that's been batted about for what, Grant, since you've been doing interviews, 15 years or so, the great inflation deflation
Not quite
debate?
that long, but pretty close.
Oh, pretty close. All right, so I just looked at Truflation's numbers, and I assume both of you guys are familiar with Truflation. They're just a private company that has an alternate way of calculating their version of CPI, and it's based on a basket of millions of goods and services. So it's not, a lot of Excel models like the BLS uses. This is supposed to try to be more like a real world estimation. Surprisingly, their numbers don't differ all that much from the CPI in terms of their methodology. So I say that because if you don't like the numbers I'm going to tell you, assume maybe reality is a little bit higher. But in the US, since January 2020, they calculate compounded inflation as 25%, over 25%, which means in just the past 4 years, the purchasing power of your wealth, if you're an American, got cut by a quarter. You lost a quarter of its purchasing power in just 4 years. In the UK, that's over 37%, right? And these are largely due to, emergency policies, but these were policies that the public didn't get a chance to vote on. And here we are just a short number of years later, and, people are living with the after effects of this. So, I'm curious to just at a high level get your guys' sense of the implications of this. Obviously, there are things like, just the diminished prospects of having less purchasing power. Obviously, there's an increase. This just only increased the wealth divide because this pain isn't felt evenly. Like, yes, everybody feels the same diminishment of purchasing power, but if you hold assets, particularly financial assets, those gained in price faster than this rate of inflation. So you're coming out of this in a net better position. But of course, financial assets are owned by a much smaller percentage of the overall population. So that wealth imbalance that we had going into COVID has only gotten worse. So as you guys look at the inflation landscape, what do you see as the implications of this pretty dramatic hit that currency purchasing power just took? Why don't we start with you, Grant?
Yeah, I'll let Steph go into the numbers, but I think the really important shift here, and it's actually fascinating. If you ask people what's the CPI, they'll quote you a percentage. CPI, the I stands for index, right? It's not a percentage. People will tell you that the CPI is 2.6% or 2%, or the CPI is coming back to 2%. That's just the rate of change. And this is the really, really important thing. And that's why this compound inflation idea that you talked about there, Adam, is so important, because obviously when it compounds, the prices go up 2%, 2%, 2%. When they speed up, if wages are going up at the same level, you don't really have that much of a problem, really. But things are getting more expensive, but you're not struggling to make ends meet. What we've seen post-COVID is a sharp rise in inflation. And it's now the I part of this, the component of the CPI, the index, which just keeps going up and keeps going up. And it's the perfect bottom left, top right chart, as you would expect it to be. But it's crossed the threshold of unaffordability for a lot of people. So it doesn't matter that inflation's come down, that inflation's now only 2.6% or 2%, and they should get back to 2%, because it's 25% over 4 years, and that's unaffordable for people. And so it's amazing that they've managed to be able to quote and have people think of CPI as a percentage number for so long, but nobody's thinking of it as a percentage now, except economists and people in the markets. What they're looking at is their grocery bill and their restaurant bill and the cutbacks they're having to make. And Steph, I'll let you talk about pet spending and stuff like that, because you've done such great work in finding these things that really speak to where people are being forced to make changes in their spending habits in places they would never ordinarily do. So that's where we are. And the genie is well and truly out the bottle now, unless you can either raise wages so people can afford these things again, or get prices down, not just slow the rate of increase. You are going to see all the things that we're seeing. And it's not just a market phenomenon, it's a societal phenomenon. Go back to the 1970s, all the things we're seeing now, with the exception of the wokeness, but the race riots, the anger, the kind of palpable boiling point that people have, a lot of it is down to this inflation problem. It's down to the frustration they feel about not being able to keep up with the cost of living, with a new generation that are going to be the first generation not to do better than their parents for countless generations. This is a very real world phenomenon now. It's not an economist number. It's not a number that the Fed can spout from the podium in the press conference and tell you what a great job they're doing in lowering inflation. This is a real world problem, and real world problems require real world solutions. And unfortunately, I am not sure that most of these central banks or governments are in a position, given the debt levels, given the balance sheet constraints, assuming there are any, to provide the solutions required to solve this problem quickly and quietly. And that's, I suspect, going to be a highlight of the rest of the summer and into the election in November.
Okay, I'm going to put a pin in that because I want to come back to that. That last point, and it's specific to something you just tweeted out the other day relevant to it. But Steph, let's let you pick up the baton here.
Well, there's so much to say on this. First off, I obviously 100% agree with everything that Grant outlined about the important difference between the rate of increase versus the absolute level, and the burden that is placing on average consumers. And I don't think it's any surprise that 3 out of 5 Americans think we're in recession, and that it actually started last March. And it's because of this inability to afford absolutely everything, despite the headline inflation numbers coming down. And I would further underscore, I know you looked at the Trueflation. There's a fellow named John Williams who has a website called Shadow Stats, and he has for decades tracked, sort of has his own way of measuring inflation and growth, et cetera, avoiding some of the monkey business, let's say, that these government statistical agencies use. And as
Right, and
relates to
sorry to interrupt, but John largely uses the old equations that we used to use
that's
before
what
they
I
all
was
got hedonically monkeyed, right?
correct.
Yeah.
Exactly. He uses what he calls a pre-Clinton CPI that is before they started doing these hedonic adjustments, which basically say if you bought a car today and you don't have to manually roll down the window, therefore the price of that car is massively lower. because you can push a button. So somehow that's deflationary. Using that logic, I would argue that we've experienced massive deflation since caveman times, when we used to have to go and hunt our, bison for dinner rather than strolling down the aisle at Kroger. So anyway, that's another story. So, but by his measure, the peak inflation, which the BLS puts at, what was it, 9.1 or 9.2, was over 18%. So he clocked the growth in inflation at twice the pace. So presumably the average American's even deeper underwater in terms of real incomes. Speaking of real income, since I am the data nerd here, within the University of Michigan survey, they have a number of components. One of the ones that is most telling about where we are is the outlook for real income. Do you think your income will outpace inflation? That hit the worst reading in the history of the survey. And that survey goes back to the 80s. So just let's put this in context. People think that their income outlook is worse today than it was when unemployment was 10% at the depths of the global financial crisis, the Great Recession. So they're more dire now. Imagine what the situation will be for them as the unemployment rate moves from 4.3 to 5 to 6 to 7. And as Grant alluded to, you can see they're already pulling back on all kinds of spending, including things that I would view as non-discretionary, like your pet. I highlighted that because it struck me as, the last things you're going to pull back on would be medications for yourself or food and medications for your pet. And we've seen a decline in pet spending in real terms for 20 months in a row now. The longest stretch we've seen in history. During the Great Recession, we saw 19 months of declining. So we're already worse. And again, the unemployment, shoe hasn't really dropped yet. And obviously you see that reflected in some of the stock prices of these companies. And then you expand the lens to consumer discretionary spending in general, and it's getting hammered. And, as Grant was talking about this, I was thinking, there's a psychology around inflation. And we've probably most vividly seen this in Japan on the other side, where the psychology of deflation became so embedded that you really couldn't get out of it, because people thought, why would I buy this today when if I wait a month or a year, it'll be even cheaper? I may as well forego spending now and buy later. And one would presume that the opposite mentality would be happening today, where people say, look, if I don't hurry up and buy this car, this washing machine, whatever that we need, if I don't buy it now, it's going to be so much more expensive 3 months from now. So I got to do it now. If we're seeing that behavior, then we're really in trouble, because the consumer spending numbers are so dismal. And it doesn't show any sign of sort of anticipatory spending. So to the extent there is an inflation psychology, clearly consumers are completely spent up, lent up, and now they're just struggling to get by. So boy, that's depressing, but
Okay. But no, this is exactly the territory that I wanted to head into. So, Grant said, hey, unless, you can deal with inflation if wage growth is growing at or above the rate of inflation. I'm pretty sure I know the answer to this. But Steph, do you see anything in the data that suggests that that's going to happen here, or are wages heading in the wrong, or is wage growth heading in the wrong direction?
I'm just looking at employment, the history of employment broadly. And when you go up, you interviewed Claudia Sahm recently, but even putting aside the Sahm rule, if you just look at when you've seen periods where the unemployment rate has moved up 0.5 percentage point, just not even on a 3-month average basis, or what, just nominally from, we went from 3.4 to now we're at 4.1, but even after we had only moved up 0.5 percentage point, from there on average, you go up another 2.9 percentage points. And that's the average, excluding COVID when the unemployment rate went to whatever 20 some odd percent. So I excluded that, assuming that was a very anomalous situation. But that suggests if we were at 3.4 and we go up basically 2.9, you're looking at an unemployment rate that's going to be north of 6% in short order. If you look at a historical chart of the unemployment rate, it isn't some gentle, rolling hills. Looks like a credit spread chart. And so you tend to move sharply higher. And I don't see any reason why it would be different this time. In fact, if you cast back at probably 2 years ago, when we were talking about the idea that there was this labor hoarding situation going on because companies couldn't get workers to come back after they were being paid to sit at home post-COVID. Now that they actually reached full staffing, which took a lot of work on their part to do, I think there's been a real reluctance as the economy seemed to be slowing to lay people off. And you see that in the employment data, that what they did was they cut hours and they moved people to part-time rather than full-time. And that's why you've seen the drop in full-time job growth.
Right.
And
And hires
also,
have gone down too.
right. And everyone's had to take out second and third jobs because their hours were getting cut. So
Yeah.
and you and I talked way back then about this idea that we could go from a labor hoarding environment to a labor shedding environment if people, companies perceived that the slowdown was going to be more material. And so I think we could be reaching that moment if the assessment of where we're headed continues to deteriorate. And I guess, the outlook for the next administration will factor largely into that. Or at least it'll be one of the many factors. But right now, my guess is that you'll continue to see pressure on wages. A very long-winded answer to your question.
No, but great question. And that transition from labor hoarding to labor shedding, one of the points we were putting under it is that tends to happen quite quickly. That again, that's sort of a sentiment shift, right? Where they realize like, you know what, we're not going to make it through this period. We got to start cutting costs, and we've been holding these people on for as long as we can. Now we got to start getting rid of them. And you talked earlier about this. I've been showing this chart a lot recently, but this is just the unemployment rate. And as you can see here, what it does between recessions is after a recession, it starts coming down and it goes down, 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 down. It gets very quiescent, and then it starts turning up, and then bang, it spikes dramatically. And that's the pattern at every one of these. And it even happened in COVID, but I'm not going to use COVID because that was kind of an outlier. But pretty much every recession in living history here followed this pattern. And if you look over here, now we've come down, we've bottomed, and now we're starting to come up. And so you have to have some sort of really compelling argument why it's going to be different this time to not expect this thing to start jumping again. And of course, we just saw the triggering of the SOM roll, which suggests that unemployment is really starting to grow right now. I interviewed Anna Wong, who's the chief economist for Bloomberg Economics. She's got the highest outlook on the street for unemployment by the end of the year, and she's still a mainstream economist, right? She's not someone who's usually making really extreme calls, but she's got it at 4.5% by the end of this year. I'm actually going to take the over on that. But even Anna said, look, if we're going into a recession, that number could easily get 5, 6, 7 higher. But she did say by the end of this year, if we're at 4.5%, that's going to feel like a recession to people. Sort of like Grant was saying, is we're potentially transitioning into this time where pretty soon the debate may be over, right? Because still even now there are data points you can use to cherry pick, right? And somebody could say, hey, look, the GDP grew at 2.8% last quarter. What's wrong, guys? I mean, isn't this great? So it's going to be interesting to see what happens. But in the interest of time, let me move on to my next question here. Grant, you posted, I thought, an excellent just sort of explanation of inflation by Jim Walker on your Twitter feed the other day. And I can't quote the whole thing because it's too long, but I pulled some key quotes out of it. He said, the natural state of the economy is to generate deflation, aka productivity growth. He then claims that central banks fight this natural state because it makes it harder for governments, not people or corporations, but harder for governments to pay down debt. And he ends with this: the generation of inflation by central banks is an effort to provide governments with an easy way out of their debt problems through inflation rather than fiscal prudence. So, we have this sort of imbalance of what I think people would say is sort of the healthy benefits of natural deflation that are being deliberately overwhelmed by central planning intentions. And honestly, intentions that at the end of the day aren't in the best interests of the people or companies inside the nations themselves. It's just so that the power structure can keep the game it wants to play going on for as long as it can. Please take just a moment to sort of share your thoughts on this.
Yeah, look, Jim's a brilliant guy. I was talking with him a couple of days ago, and he really he really opened my eyes on a lot of things. And this quote which Jim published probably 5-6 years ago, I just thought was a very well articulated summation of how the system works. I don't want to use the word system pejoratively, just the financial system we're in here. And I think it's important to understand this at kind of turning points, because when everything's good, it doesn't really matter. When everyone's doing okay, it doesn't really matter. But if you, me, and Steph's wages are unchanged and the price of goods is coming down, we're pretty happy, right? That life is the opposite of what it is now. Things become more affordable. You take pressure away, and if you're an individual or a company, you tend to be much better at managing your credit exposure because you can't get it. Right? No one's going to give you credit if you have a bad credit rating. If you can't pay off your monthly payments, you tend to either have to declare bankruptcy or default on the loan or whatever you have to do. We live under a very different set of rules to governments, and they've had this ability to put their thumb on the scales for many, many decades now. But through those decades, what's been happening in the background is these debt to GDP ratios have been getting bigger and bigger and bigger and bigger. And I was talking with Russell Napier today, and we were talking about the conditions when Margaret Thatcher came to power, which were very, very similar, and the steps that she took to try and right the ship in the UK, she could do because Britain's debt to GDP was 30-odd% back then. So a lot of the tools that central banks need to deal with these problems, they don't have at the moment because they're so drowning in debt,
right,
that they absolutely need to somehow inflate this problem away. And had they been able to generate 2% inflation gently, like they swore they'd be able to over the last 15 years, this problem wouldn't have been solved, but it would have been ameliorated to a significant degree for them. But they've been singularly unable to do it. And not only have they been unable to do it, in the pursuit of that gentle outcome, they've been adding more and more debt to the past. So it really is, it's a very, very tricky situation for the central banks. And, my conversation with Russell today, he's been a big proponent, not proponent, but he's been warning as much as he can about the prospects of financial repression being the choice of action from central banks, not because it's necessarily their preferred choice, but they've reached the point now where it's the only real option available to them.
It's their only choice, if they want to keep the status quo going.
It is. And so we get to this, Marco Papic has this great way he looks at the world through this lens of constraints and preferences. And I think he said to me once, we live in a world which we want to describe by our preferences, but we're forced to do it through our constraints. And we've had 20 years of central banks and governments going down the road of their preferences, lower rates, better growth, handouts and subsidies to people to buy votes, etc. Now we've reached the point where it's going to be a question of what their constraints are. And the biggest constraint they all have is debt. And really, we know there are a certain number of ways you can get rid of debt, but most of those are now impossible. Financial repression, however, is really the only one left for them that is viable. And because we're in a world of extremes, one of those extremes is the divide in inequality, the difference between rich and poor. And if you want to put financial repression in place, having a wealthy class who are inordinately more wealthy than the average middle class or lower class individuals in a society gives you the perfect bugbear, gives you the perfect target for this financial repression. And so, Russell's adamant that this is what's in our future. I think he's absolutely right. What it looks like and how long we have until it gets implemented, I don't know. But once a government is forced to do this, I think all the other governments will watch. And they're all already looking at ways to increase inheritance taxes and wealth taxes, and you can see all that happening already. But when those don't generate the taxes that they promise they will,
Right.
which never ever happens,
Never ever happens. Yeah.
never, they'll be forced to come and take money because they can't print any more of it, because we've seen what happens and we've seen where we are in this inflation dance now. So printing more money is just going to tip that over the edge. And once you can't print any more fake money, you have to get the real stuff. And you can only get the real stuff from the people that have it. So I think that's coming and people need to be aware of it. And I think when it happens, it will be pushed as a tax on the wealthy. But I think people will be very, very surprised to find out that obviously everyone's definition of the rich is basically anybody richer than me.
Mm-hmm.
But that's not how this is going to work. I think you're going to find people getting pulled into the wealthy category who aren't particularly wealthy. They might live a wealthy life in that they've got a big house with a big mortgage that they can afford because rates are low. But if there's a one-off hit that the government has, or they're mandated to put money into government bonds, which is one of the most likely routes for financial repression, suddenly they're going to realize that they have wealth and it's not liquid wealth, and they're going to be forced to come up with liquidity at a time where there aren't going to be many bids around. So, people need to understand that the world has changed materially in a meaningful way that perhaps isn't obvious right now because markets are still pretty high and there's a lot of time and energy and focus placed upon what the stock market did today. And the market bounced back after that wobble last week. This is a much bigger, more secular change. And those are sometimes difficult to see when you're this close to them. If you step back, which is the beauty of looking at things through a historical lens, you can see them quite clearly. But at the time, and if you're not paying attention, they can be very difficult for people to see.
Okay. Great answer. There's so many things you guys are bringing up that I feel like I could do an entire interview with you just on that topic. This whole thing about financial repression, so important. I'm not going to be able to do it justice here, so I'm going to have to veer off from this, but I will commit to the audience here that I will do an interview in a relatively near future, just completely dedicated to financial repression, as well as the sort of so what, like, okay, if that's the future direction, what can we as people do about it? I just want to say what Grant's talking about is likely not something you're going to wake up tomorrow and see fully enacted. That this is going to be a long trend, likely going forward from here. Some of the things I want to get into in the rest of the time we have, guys, are a little bit more short term. One of the reasons why I brought up this quote from Jim Walker is because, interestingly, he's saying, look, kind of the natural job of the economy here is to create this sort of benign deflation over time. I think if we just had all the central planners remove their hands from the system right now, natural market forces would completely deflate asset prices right now. Right? There's so many unproductive debts, et cetera, that just need to be cleansed from the system. But again, nobody wants to preside over that. So everybody in the existing power structure is doing everything they can to keep that from happening. That was, largely Jim's thing, which is like, hey, look, even though deflation wants to happen, the power structure wants inflation, and for the time being, at least, it's going to get it, right? So where I want to go now is, okay, so what do we think is likely to win out in the here and now, like over the next 12-ish months or so? And Steph, you've been, I think on the deflation side of the line in terms of that's where the trend is going. I don't think anybody would argue that we are in disinflation right now. And the question is what's the likelihood that that could become deflation in a materially soon time frame? And by materially soon, let's just randomly pick the next 12 months or so. I know in the past you've told me that people tend to forget how quickly you can you can move from a rising inflation to a deflation regime, as we've seen in some of the crises in the past. But as you project out, looking at all the data you look at right now, where do you think inflation is headed over the next 12 months?
Well, there's an important distinction which you started to make there between disinflation and deflation, and I think we are seeing prices disinflate. And even in the period that I like to um, harken back to during the Great Recession, when inflation, people forget, was actually 5.5% before we went into the global financial crisis, and within 12 months it was minus 2.1.
Mm-hmm.
Even that I would describe as disinflation rather than deflation. When I talk about deflation, I'm thinking about a debt deleveraging type of situation that's more long lasting and much deeper than just, even today, if we went to minus 2%, as Grant articulated so well at the top, it would take a lot of that, several months of that, to bring the total price level back to where it was before we started this whole crazy inflation run. So my sense is that we're heading into a disinflationary period. And then depending how bad things get and how far behind the curve, I hate to use that phrase, but the Fed ends up being, it will define whether or not we actually go into a debt deflation. And one thing that I would kind of add, and it's a little bit of a tangent that I think is interesting in this conversation and brings in the context of the yen carry trade and the possible unwinding of that and the impact that might have in terms of deflating asset prices,
Mm-hmm.
which I think would be the catalyst for a more substantial disinflation that could turn into a deflation. One thing that's going to be really interesting this time around, that, dreaded phrase that's going to be different this time, is the outsized position that a lot of investors, and I'm thinking pension funds, hedge funds, insurance companies, now have in highly illiquid private assets, whether it's venture capital companies or private debt. These assets cannot be liquidated at any price in the kind of risk off scenario that I am describing, sort of a repeat of a 2008 scenario. That's going to put outsized pressure on publicly traded assets. So even though you may own best in class companies that are going to be around forever, you could get brutalized, you could get flogged for the sins of the illiquid assets that all these investors can't get rid of. They have to just sit there with those. They're not going to be a market for them. So they're going to have to liquidate everything else. So that, I think, could be a compounding factor.
So
But so
margin call on a grander scale than we saw in
exactly.
2008.
And the scary thing is about it is I'm just hypothesizing. There's no way to quantify how big that market is, much less how much leverage is underneath all of that. So we won't know until the shoe drops. We won't be able to get a sense as to how much money is actually tied up in these vehicles. And people have to meet margin calls or just raise cash to meet regular business operations. So I think that's another moving part to this story that will be interesting to watch. But generally, my sense is that if we have the asset bubble bust, which I anticipate we will, as investors realize that the Fed is not, in fact, going to act preemptively, then you'll get into a real disinflationary period. The question is, how long will that last, and will it actually get deep enough to lead to broader deflation, which, given the demographics and the massive amount of debt, is a possibility. The problem is, as you and Grant just described, the appetite for that kind of meltdown is non-existent. And so one presumes that the second it becomes clear we're staring into that deflationary abyss, both fiscal and monetary policy makers will come in with the fire hoses and pump, a ton of liquidity into the markets, and then we'll be back in the same situation we were when we were looking at 9% inflation and runaway deficits, and then we'll have to cross the bridge as to what that means for the dollar and reserve currencies, etc. But I know we don't have time to get into that whole
Yeah, well,
discussion
and
now.
I mean, I wish I'd been able to book you guys for 3 hours here, and then we would get into all of this. But we'll take bites along the way over the next couple of months. But if I can simplify, and I know I'm painting with a very broad brush here, there's sort of three time epochs that we're talking about here. One is the near term, which, Steph, I think you say, look, that's disinflation, and there's likely a downwards asset repricing in there for the reasons you mentioned. Then we'll call this medium term. There's then the policy response to that, right? If and when it gets bad enough, and I think we all kind of think that it's probably, there's zero tolerance for pain, like you said, so it's probably going to be sooner than later. The central planners will come in, they'll turn back on the stimulus spigots, and we'll be right back into all the issues of inflation and currency devaluation stuff that we've been talking about. Then there's a longer term, which is the financial repression that Grant was mentioning there earlier. Just because we're real short on time now, let's just talk on the short term here, which is, okay, if you think it's likely we're going to enter into this disinflation, more disinflation, plus asset downward repricing, what should today's investors be doing to make sure that they don't become collateral damage to that? I'm going to ask you that question directly, Steph, and of course I'll then go to you, Grant. But real quick, Steph, before, one of the key indicators that you've told me that you watch closely, and Grant briefly mentioned these earlier, is credit spreads. And credit spreads hadn't really been doing a hell of a lot. I do believe, correct me if I'm wrong, that we've started to see some movement on the lowest quality level, of the credit market in terms of credit spreads beginning to widen a little bit. Is that true, or maybe just more broadly, what is happening right now with credit spreads? What are they telling you?
Yeah, they've definitely started to move up, albeit, as you said, fairly modestly and from extremely tight levels, because I believe, everyone was wagering so aggressively on this idea that the Fed was going to cut in anticipation of any problem. So why, do you need to underweight risk when the Fed's going to make sure that the market never stubs its toe?
Jay Powell's got your
So
back, yeah.
yeah, and so you saw a dramatic repricing of that on that Friday with the payroll employment report. You've given back a lot in terms of spread uh, in the last week or so, but generally the trend is higher on that score. Um, and I guess to your broader question as to where do investors hide, given my concerns about publicly traded assets getting brutalized for the sins of the illiquid assets, I'm fairly leery about owning any paper assets right now. I mean, I continue to be almost totally invested in gold. I have a small exposure to the gold miners, which I think I will build after the repricing and risk happens, and there's an opportunity to get in there. And then obviously I think there's some opportunity at the long end of the treasury curve as another thing that surprised me is that speculators actually increased their short positions in the 10-year
Hmm.
on the heels of the payroll report, which kind of blew my mind. I would have expected them to be aggressively covering those bets on the idea that the recession was here. But no, they're still boldly wagering on higher long rates. So I think there's some opportunity there. But other than that, I'm very defensive, maybe a little position in oil or a handful of selected commodities, but I'd really be sitting in cash right now.
Okay, and that's the last thing I was going to ask is cash/short-term U.S. Treasuries. That's a position of yours you still hold, correct?
Yes. Yeah.
All right. Grant, what would you add to that sort of question of for those that don't want to become collateral damage right now, what should they be? What strategies or assets you think are worth considering?
I wouldn't add much to that, to be honest, Adam, in terms of what that prepares you for. I think gold is likely, to Steph's earlier point, to be one of the things that gets flushed out in the short term when people get margin calls and they can't meet them with illiquid assets. Gold is just like we saw in 2008. We saw gold fall. A lot of people scratching their heads. It bounced very quickly, which I suspect it will do again. particularly with that strong central bank bit under it, but people need to understand that in the kind of flush out Steph described, gold will be one of the things that's hit because it is liquid. I think you can still get 5% on the short end, and I think there's nothing wrong with that. I was talking with Russell again today, and he said Jane Austen will tell you all her characters are very happy with 5%, and that's a number that goes back several hundred years. But one thing I would like to just add to what Steph was talking about now, because I think it's a really important thing for people to realize, this idea of inflation and deflation, because everybody's being asked to pick a side. What do you think is coming, inflation, deflation? And it's a lot more complicated than that, because if you think about what's happened, let's just take post 2008. We saw this massive deflationary event in 2008, which essentially was a deflation in asset prices, which had gotten way too high. Commodities had gotten too high, house prices had gotten too high. There was a deflationary episode in physical assets like that, and that ultimately triggered a lot of leverage problems, and that's what took us down. Since then, the central banks have been trying to create inflation. And everybody was worried about the CPI getting much higher with all this printed money. They didn't get that. They got significant inflation, but in asset prices, which didn't really matter because that's good inflation, right? Asset prices going up for those that have assets. The man in the street wasn't hurting too much because the CPI rate of change was low. Prices were still creeping higher. Now everything's flipped about. And so what we're seeing now is this, when we talk about disinflation, deflationary events, we're not talking about it in the price of food and the price of rent and the price of housing and the price of healthcare. It's not going to be that kind of deflation. It's
Right,
a deflation in asset prices. Yes, no, exactly right.
Yeah.
Exactly right. And so the Fed policy of low rates was supposed to generate growth and asset price increases. That was the ultimate aim of them. And the stated aim to the man in the street was to create 2% inflation, by which they meant, CPI inflation of 2%. They failed miserably at that, and they succeeded wildly in raising asset prices. They're now flipping this around and saying, okay, we're going to have to cut rates now because we're worried about a deflationary event. We're worried about a recession. And what we're going to intend to do is bring inflation down somehow by cutting rates, which is an interesting move, but we'll see, but keep asset prices stable or deflate them gently. It's not going to happen. It's absolutely not going to happen. So what the Fed promised us on the way up, they singularly failed to achieve, but it didn't matter because it was all good and asset prices went higher and people felt wealthier. And this whole wealth effect, fallacious though it may be, gave them enough juice that they could get plenty of positive media coverage. When things go in the other direction, their failure is going to be the worst kind of failure, because when they fail to get this one right, it's going to be absolutely obvious in the fall in house prices and the fall in stock markets and the fall in bond prices. And there's no way to hide and dress this up. And it makes it worse if they can't get prices down in terms of goods that people are looking to buy every day. That just makes it worse. And we spend so much time talking about the Fed, but let's just spend a moment. I know we're running short on time, but let's just spend a moment talking about all the other ways in which food and rent and services and healthcare prices can be sticky or go higher. We have supply chains that are broken since COVID. We have a lot of moves to reshore, which is going to increase costs significantly. There are all kinds of reasons why other countries are going to start to manage their currencies for their own national interests. So this split that we talked about at the beginning, where it used to be all for one and one for all, and now it's every man for himself, so many of those potential moves by other central banks, particularly in currency markets, we've seen the Japanese have depreciated the yen 35%, and they've only just been very, very quietly labeled a currency manipulator, even though the Americans said, well, we don't really want to do this, and they're not really currency manipulators, but they're kind of currency manipulators. Can you imagine if China had devalued the renminbi by 35%? What would be going on? It's a full-blown trade war. And so there are all kinds of moves that are going to be forced upon other governments around the world that will import inflation into the United States, into Europe, into the UK, Australia, Canada, all these Western countries, that will make these prices sticky, while any kind of deflationary event is going to be a deflationary event in asset prices, and it's going to look horrible. So I have never wanted to be a Federal Reserve governor on the chair of the Federal Reserve. Right now is possibly the worst time to have that job. So I wish Jay Powell, if if he stays, all the luck in the world. I think he's going to need it.
There's such great points, Grant. And in fairness to the Fed, they're not the only game in town here. The
No,
fiscal side is actually at this point in time the much more profligate side in the here and now. And of course, that's happening in many other countries too around the world. So that's just one more big ingredient to put into the soup that you just mentioned there. Is, we have world governments that their expertise is spending an ever increasing pie, and they're not going to stop doing that until forced to.
well, the pie's not getting any bigger. That's the problem. They want to
Yeah,
spend
that's exactly
increasing
the
amount of
problem.
money.
Yeah, but they're not going to
Pie's
stop
not
the
getting
spending part, and they will do everything they can to try to keep that pie to be as large as it is, no matter what the future costs are. Right.
Yeah, absolutely.
Okay. All right. Look, again, I know the audience is just dying for me to, keep going with you guys for many more hours on this stuff, but I'll just have to, you guys willing, of course, have you guys back on at different points again in the future to dive more deeply into each one of these things. If I can, I'm going to start getting to the wrap up here, but there are one or two questions I just wanted to try to slip in here. Grant, this is unfair to ask you to answer this in a short answer, but just give me literally the 30-second answer if you can. Stephanie mentioned gold. You just mentioned gold. I have to ask you this because you're the guy that penned that famous piece, Nobody Cares About Gold, many, many years ago. Are people now beginning to care about gold?
About gold, yeah, they are. Not everybody though. Central banks are beginning to care about it a lot, and we've seen purchases by central banks almost triple since the Russian assets were confiscated back a couple of years ago. Eastern investors are caring about it a lot more.
They care.
Western
Yeah.
investors, not yet. And gold mining companies, nobody cares still. I gave that presentation almost 10 years ago. There's been periods in time where they have,
now.
but not yet. But they will. They will because that's the way these things work in times of crisis.
Okay. And I had a conversation not that long ago with Ronnie Stafferly, who pretty much gave the exact same assessment you just did, but said that, he thought the next sort of milestone here was the Western investor, when they start waking up, that could really be a catalytical event. And I've heard some rumblings recently that we've seen some more interest in the West, not a ton, but maybe some positive ETF inflows and some things that we haven't seen in a while. So I just was curious to see if you thought the Western investor was at least cracking open half an eye yet.
Well, I think when the Western investor does wake up, the day that realization dawns them, they're going to realize just how underweight they are in gold because they have zero. And to get from zero to any kind of weighting, I mean, 2%, it's not enough. I don't think it's going to be enough, but to get to there is going to completely change the flows in the gold market, and you're suddenly going to have an awful lot of people competing for that marginal ounce of gold, which will be very interesting to watch, I think.
Okay. And like I said, super unfair to ask you to opine on that with such a short amount of time here at the very end, but in the future, we'll get into it in more detail. So, Steph, I'm coming to you just a minute. I'm going to stay with Grant for 1 second, which feel free to add on to, but it's Grant's favorite topic, which is sport. I just figured I couldn't have you on and not ask you about the Paris Olympics, Grant. And I guess my question is maybe this is a forced analogy, but we're sort of talking here about the central planners have been forcing a desire, a narrative, but in many ways sort of against reality, against natural market forces. And the problem they have is eventually you get to a point where reality just kicks in, right? And that's part of the danger of the system here is that things get so distorted, so deformed that when reality kicks in, the damage it does is way more than if we had just not been fighting it the whole time around, right? And I think about the breakdancer from Australia, right? Who somehow made it through the qualifiers, or he got it to the end, and was this sort of story of pluck and confidence, and then got to the games, and then it was just clear to everybody that she just had no breakdancing skills. And I'm wondering if that's a fair analogy here.
Yeah, I mean, it's not one I'd thought of. I've spent too much time laughing at all the clips of the breakdancer to really give it any serious thought. Um, Certainly not in a financial context, but yeah, I think there's something to that, Adam. I think this idea that when the spotlight goes on, you have to perform. Um, you better be really capable, and unfortunately, she had no idea who her opponents were going to be, because, hey, look, there could have been a breakdancer worse than her. Maybe she would have won a round. But as it turned out, her opponent was were all way better than her or much stronger than her. And I suspect, to try and tie up your analogy, I think a lot of these central banks are going to find themselves facing opponents that they're not strong enough to defeat. So it's going to be an interesting period of time. And that's not to say there aren't going to be ways to either protect your wealth or grow it, but it's not going to be anywhere near as easy as it's been for the last 15 years, which has just been buy assets and hold them through thick and thin.
So this has been a common theme in a lot of my interviews, Grant, and you've made this comment many times before during our own interviews, but it sounds like you're still a very similar mindset that an active investing approach is going to be much more critical to success going forward, versus the past era where passive has worked just fine.
Yeah, and that's passive with a small p. This isn't, a lot of people have got their money going into these target date funds or a lot of these passive engines already, and it won't be until they start getting statements that show material declines that they'll adjust that. But I think for people who actively manage their own portfolios passively, if you understand what I'm trying to say, um, it's time to really think about what you're doing, and whether, and I gave a presentation about this not long ago, whether you are capable of navigating the next phase of this yourself, or whether you need help with it. And there's no shame in asking for that help, because this is we're talking about irreplaceable capital here. And so, as my friend Rick Rule likes to say, a lot of people confuse brains with the bull market. There is no shame in assessing whether, given the moves you saw last week, if that was the norm, are you equipped mentally to deal with that with your portfolio? Because if you're not, it's time to have a think about finding people who can help you do that. I think it's a really important thing for people to realize.
All right, thank you. And I promise, folks, I didn't pay Grant for that statement.
No, and if you did, I haven't got the money yet. So,
but at the very end, I will remind people about, most people who have real lives, real jobs should be seeking a good financial advisor who can play their quarterback for this type of environment going forward.
yeah.
All right, Steph, coming to you. Last question before we wrap up and hear about your conference. I've talked a lot in this channel about how, really, at the end of the day, money is wonderful, but it is a means. It is not an end in and of itself. And if you talk to people about what really matters in life, particularly people who have lived a full life, like to 100 or beyond, their answers pretty much all boil down to the same three things. And it's quality of relationships. We're tribal creatures, after all. Meaning that your life had some sort of purpose, right? That your days mattered in some ways that were important to you. The world's a little bit better off that you existed. And then the third is good health, which is self-evident. You can't live a long life if you don't have good health. So my question for you two, and we'll start with you, Steph, is where do you find meaning in your life right now? What nurtures you, on a daily basis? Where do you look to find that purpose in life?
I'm so tempted to say Seinfeld reruns, but I guess oh my God. I don't know.
Hey,
Sitting here
Steph, they
listening
all
to
think you're
Willoughby,
joking. They all think you're joking. You and I
I'm
know.
only half joking, right? Exactly. Oh man. Now, I mean, uh, it's hard to get super philosophical while I'm listening to Wilhelmina snore loudly in the background. But now you're 100%, I'm just going to rehash what I've said prior. And that is, as you said, you've got to find things that give your life meaning and satisfy your soul in some way. And, for me, that's friendships with people that I really value in my life. But also being intellectually engaged every day in, the pursuit of knowledge and truth. I mean, that sounds stupid, but one of the things that I love about this business is that you don't get up and look at the same thing every day. It's
Mhm.
ever changing. You're constantly learning. And for me, I think even if I won the lottery tomorrow, while I probably wouldn't feel obligated to write a commentary to clients every week, I'd still want to have the intellectual exercise of trying to figure out, okay, well, if these are the inputs, where are we going and what is the most likely outcome? And, have I thought through this properly? Should I have someone debate me so that I can have my argument tested? That kind of stuff I find so exciting and invigorating and keeps me going. So, I mean, in addition to the social aspects, keeping intellectually active, I think is really important. And of course, having a fur baby that snores loudly in the background doesn't hurt. So
Those are all excellent answers. Thanks. How about you, Grant?
Yeah, look, I think people, surrounding yourself with the right people, and spending time with people that A, you genuinely care about, and B, to Steph's point, you can discuss things with. And God knows in today's world, we all need to be able to discuss topics with our friends and the people we trust that we just can't discuss anywhere else. And so, hanging on to a core group of friends where you can actually bring up topics and try and get a sanity check on the world around you is really important. Being outdoors, I love to play golf, and I find that it's a great way for me to switch off from worrying about all this stuff and worrying about
Mhm.
how terrible my golf game is, which is a nice diversion. And my grandkids, I've just spent a week with my grandkids, and I was exhausted at the end of it, but boy, it was a lot of fun. So, chasing them around was quite the experience. I'm not sure.
his
I'm not sure.
they're the most adorable little girls. They're so cute.
y- Yeah, you know what? Next time I'll take you a video at 3 a.m. Uh, and we'll exchange
That's
notes on
fine.
that. But
Just
yeah, but
don't send it to me at 3 a.m.
right,
That's all.
no, right. But look, I think, Adam, for everyone has to find those things, and they're not, as you say, they're not necessarily money, right? They're time. Time is our most valuable asset. And you don't realize it when you're young, and why would you? Because you have so much of it. But I think that the more time you spend in the world, the more time you realize how important time is, and the more you realize that spending that capital wisely is perhaps the most important decision we make every day. So I try to do that, and I'm not great at it all the time. I spend way too much time working, but I love to do what I do, and so I'm fortunate. But yeah, I think time management is increasingly more and more important.
Yeah, excellent answer. You may remember the previous business, we had this thing called the 8 forms of capital. And we would say that time capital, really, at the end of the day, was the most valuable of them all.
Yeah.
Well, look, at some point, if you're having a bad day on the golf course and you want to feel better about your game, just call me up. I'll come play with you, and you'll see what an absolutely terrible golf game looks like. You feel much better.
Yeah, Adam, I've had so many offers like that, and they've failed miserably, all of them, to come through what they promised me. I've ended up feeling more miserable. So I'm not going to fall for that one again.
Well, I got to tell you, that is a bet I feel very confident that I can make, that I will make you feel better. All right. Well, look, fantastic time, guys. Thank you so much. This has just been a wonderful conversation. Like I said, I could go on for hours more, but I sadly have to end to be respectful of your time. And Steph, I know you're about to hop on a televised interview. Very quickly, again, can you guys just remind folks about the date and any other details of the conference? And again, for folks listening, I will put the link to the conference below the video. And if you are listening on the podcast, can't see the video, just go to thoughtfulmoney.com/superhappy, and you'll get redirected to the right link. So Steph, why don't you give the details again?
Yeah, so we'll be in Tampa, November 13th and 14th. It's actually one day of the 14th. We have a VIP situation on the 13th, which I believe is sold out. But if you're really interested in
Yep.
that, you can
We
get
have a
yourself on
waiting
the
list,
wait
but
list.
yep.
We've got a wait list for that, which will be fun. And so that's, we've talked about some of the speakers, but Grant, do you want to give
Yeah,
some
I
generic
can give you.
remarks about some of the surprises?
Absolutely. Well, we have a commodities panel, which is which is we haven't announced just yet, which is going to be, I think, an exceptionally entertaining and interesting session. We have a fireside chat, which I'm going to host with my great friend Felix Zulauf. And Felix is just, I mean, there's nobody better than Felix at
There's
these
nobody better.
big picture. I mean, he's extraordinary. So Felix and I are going to kick the day off. Then we have Steph talking to Cy Jacobs, and fewer people will know Cy Jacobs than those who know Felix Zulauf because he keeps a low profile. But boy, oh boy, is Cy wicked smart, and he's about as much fun as you can have with a hedge fund manager, right, Steph? He's just
Right.
he's just a terrific guy. And then Peter Atwater, we'll be spending some time talking with Peter about confidence and trust, which again, I think, time may be our most precious asset, but right now, trust and confidence are probably two of the most important things to understand. Steph's going to sit down for an hour with Bob Rodriguez, and again, Bob is a real character and a genuine legend in the investment business, and he's retired a while ago, and so his name is not perhaps as familiar to people who don't have hair quite as grey as mine, but anybody my age and thereabouts will know exactly who Bob Rodriguez is, and he doesn't do this very often. He's done it for his dear friend Stephanie Pomboy, and we're incredibly grateful that he's going to do that. And then we have this debate, which I'm so looking forward to, between Kathy Wood and Dave Iben. I mean, value is subjective, right? And everybody has their own sense of what value is, and no one's done more to redefine what value means in these modern markets than Kathy Wood. And there aren't many investors who have done as much to define value, for the last kind of 30, 40 years in markets. So to see those two sit down and discuss both their own philosophies and for us to be able to pick apart where they differ, I think it's just going to be such an extraordinary opportunity for the audience to listen into. And then Steph and I are going to record our podcast live with an audience full of people with a cocktail in hand. So that's going to be be quite the thing, I suspect. So it's going to be
Yeah.
it's going to be a lot of fun. We've got some terrific people joining us. We're very, very lucky that all these people are giving up their time to come and spend it with us. And there are some tickets left. It's November the 14th in Tampa. I won't confuse things, Adam, by giving you the URL. I mean, I think if you will just stick to the one you've put, but I will pin it to my Twitter timeline, and I'm sure Steph will too, so that people know how to find it if they don't somehow manage to navigate it from there. So thank you very much for giving us the chance to talk about that. And for me, I love spending every minute I can with Steph. She's just so much fun, and you too, Adam. And I'm grateful for the opportunity to spend time with both of you. So thank you.
The check is in the mail.
No, absolutely wonderful. All right, folks. Well, as Grant, I think you said it perfectly. That truly sounds like an extraordinary event, kind of like heaven to, I think, a lot of the macro wonks that watch this channel, myself included. So folks, definitely go avail yourself to that if you're free during those dates in November. Very quickly, just in addition to the conference itself, the summit itself, if folks just want to follow each of you two individually, where should they go? Grant?
At TTMYGH, which is just the acronym for things that make you go hum, and grant-williams.com. There you go.
Okay.
Nice and easy.
All right, great. And Steph, you?
I'm at S Pomboy, SPOMBOY, and otherwise macromavens.com. That's
all
me.
right. Well, guys, thanks so much again. This has been fantastic. Folks, to show your appreciation for them coming on the show, please do me a favor, hit that like button, then click on the red subscribe button as well. There's that little bell icon right next to it. And I'll be very brief this time around, but as Grant and Stephanie both said, going forward, things are likely to get rockier, more turbulent, more volatile, and require more of an active approach. So unless you've got a tremendous success as a DOI investor, successfully navigating your wealth through times like that, highly recommend that you face the future under the guidance of a good professional financial advisor who takes into account all of the issues that we've talked about here. And when you add that requirement on, the universe of good financial advisors who actually have that understanding gets pretty darn narrow. But if you've got a good one who is serving that role for you, great, stick with them. They are literally worth their weight in gold. If you don't have one though, or would like a second opinion from one who does, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple of seconds. These consultations are free. There's no commitment to work with these guys. It's just a free public service they offer. Okay, and with that being said, Grant, Stephanie, I cannot again thank you guys enough. I wish you all the best, most success for your conference there on November 14th, and can't wait to hear about how it went. Look forward to seeing you guys each individually back on this channel in the future as your schedules allow. And everybody else, thanks so much for watching.
Thanks, Adam.